Joining us next on the stage will be our Capital Markets Spotlight Group. It will be moderated by our economist and director of research, Jodka, Chris Chou from our Development Services Group, Tom Welch from our Capital Markets Group, Doug Jacoby from our Investment Sale Group, and Chris Sower from our Investment Sale Multifamily Group. Aaron, take it away.
All right, thanks, Jim. Let's start out with something fun. Let's talk about opportunities. So where do you see the best opportunities in 2018 and beyond? Chris, why don't we start with you?
Well, I think opportunity obviously is in the eye of the beholder, but if I can focus a little bit on the urban environment, and I encourage all of you to look at the Imagine Boston 2030 document that was published by Mayor Welch and the City of Boston and the BPDA, and really is a great roadmap to tell you a little bit about where the city envisions itself in the next dozen or so years with respect to job growth, the economy, and even so much as the climate change that we're seeing in the city. And there are a lot of parts to it. It's a very big document, and it's very well written, but I think one of the aspects that really caught my attention was the opportunity of, I guess, joining existing neighborhoods and maybe creating new neighborhoods out of that. And this might be great as Boston is growing and we're always talking about, well, what else we need. We might have the opportunity to have underutilized parcels being developed that will have mixed use opportunity, a more diverse housing offering, and even, quite honestly, urban industrial, all wrapped around existing transportation. And these areas I'm referring to are the Whitehead Circles of the world, the Beacon Yards, even Suffolk Downs, which has been in the news before, and even Sullivan Square. But there are a lot of these all over in other neighborhoods as well as smaller spots, but these are the large ones that kind of resonate in my head.
Tom, are there opportunities on the debt side, on the financing side?
Yeah, there are tremendous opportunities on the borrowing side. I think that there's a great availability of capital across construction, transitional assets, and the permanent market. But I'd say probably the number one opportunity this year is to face a challenge. We see the 10-year Treasury, the consensus estimate is that the Treasury is going to end the year at about 3%. It's at 255 right now. The LIBOR futures curve for 30-day LIBOR has it at about 210. It's in the mid-150s right now. And this is tied into what Doug might have to say too, but the availability of cheap permanent capital, the great availability of it, the commercial mortgage-backed securities market, chasing it, life insurance companies, and then a very robust local banking system here means that the opportunity exists for these clients to de-risk and to either lock in returns by selling in this market with very favorable debt terms, or to lock in returns long-term with longer-term permanent financing. I'll give you an example. I know my colleague John Broderick was in the market recently. I don't know where it's settled, but he was shopping a high-quality deal, and spreads had compressed down to about 110 basis points over Treasuries. So if you think about a 368 rate, which may well be available 10 years interest only, I don't think at the end of the year you're going to look back on that and not wish you'd taken that opportunity to lock it in.
Chris, what do you see on the residential side?
Yeah, I think we're seeing, we're going to see continued opportunities in core and value-add opportunities. We talked a lot about last year about the emergence of workforce housing in markets like Allston and Brighton, Chelsea and Everett, and the development that's happened, and you look in those markets and what's happened and what's being built. We think we can see continued activity, especially around New Balance and Harvard, what's developing in those markets. Really newer emerging opportunities are really going to be more similar to what you're talking about in the WeWork space and the office side. The housing model is changing in Boston in that we've seen a significant increase in short-term furnished rentals, both on renting and acquiring buildings for multifamily use. And really what you call, it's a newer trend, but it's happening here in Boston. It's really popular overseas in New York, a co-housing model, which is it's a varying in terms of what the use can be, but it can be anything from a hotel, nightly use, a lodging house, to a traditional apartments, all of these different housing products in one building, which is unique We'll see how they're going to do it from an execution standpoint. The other opportunity that we've talked about a lot and haven't seen yet in Boston, which is amazing, and going back to the 2030 plan, it's been a focus of the city, is privately owned student housing, which there's some here. There's a few privately owned projects in Boston, but mostly what's been built on the student housing side has had some sort of university or college affiliation. There's a lot of groups in the national perspective that are trying to figure out how to get that done in this market. The city's supporting it. The bigger challenge is how you get into some of the neighborhoods with the preconceived notion of what student housing is and the impact it can have on neighborhoods.
Doug, are there opportunities by property type, or 2018 all go?
No, I think there is. Obviously, if you can get any opportunity at called value add for urban inside of 128, I frankly think there's more opportunity in the suburbs, simply because there are fewer buyers, less competition for the assets, because everybody seems to believe that the world's saved by buying something inside of 128. That's worked out that way so far, but if you look for really quality assets or quality locations that are far and above a bunch of tired B assets in the suburbs, then I think you could do pretty well, especially knowing that you don't have a lot of competition for that.
Well, let's switch gears and talk a little bit about e-commerce. So we surveyed our audience after registering for the seminar, so for those of you that partook, thank you. One of the questions we asked was, what percentage of your holiday shopping was going to be online? The most common answer, 75%. Huge, huge changes in the way that we shop. And what we're seeing now is these e-tailers opening up brick and mortar locations. Tom, what are you seeing on the retail side? Are lenders interested in the property type? Are there certain areas that are of more interest?
Yeah, well, it's interesting. Despite how liquid the capital markets are, there are two asset classes that are a little harder to finance right now. One would be hotels, whether it's because it's later in the cycle or it's an operating business. Still financeable. Retail is the second asset class that people will call out as difficult to finance. In particular instances, commercial mortgage-backed securities, quite worried about it. It's interesting, I think the e-tailing is coming in, it's still less than 10% of total retail expenditure, but it has major impact on big boxes in particular. So the insurance companies are really focused on essential grocery-anchored retail. People take a very hard look at what the sales are in relation to the rent, the total overall occupancy cost, and then experiential retail real estate. If you take a first-class product in the suburbs, like a Legacy Place or the new product that's been delivered on University Ave, something like that would be very financeable. Otherwise, you could look at national investment-grade tenants like a Walmart or a Home Depot, CVS, something like that would still be financeable. But the more marginal assets are the ones that have bigger box or secondary malls. Those are going to become increasingly difficult. But there's an opportunity there, too, for some of the more talented retail developers, well-capitalized developers to come in and reposition some of those assets.
Perhaps a pendulum swinging a little too far to one side. Chris, what are you seeing on the retail side?
Well, I think Tom summed up the capital market side of it, but I think as there's vacancies possibly from big boxes exiting in those nice selective urban or better neighborhood retail strips, there could be an opportunity for even healthcare to come in. As hospitals consolidate, as there's the fight for insurance billing, there's a compelling need to bring in the high billing into the hospital, but at the same time pushing out, I guess, patient-centric, medical office-related, or even outpatient centers. And instead of maybe trying to attract them into your hospitals, you can set them out towards the neighborhoods where everyone is shopping and whatnot. So I think there might be an opportunity that could offer a little more diversity from maybe the financing perspective, too.
And how's retail tying in with the multifamily side, Chris?
You know, it's funny. Housing seems like it's usually the first one in from a development perspective in terms of going into a market and kind of establishing a neighborhood. Retail follows closely behind it. You know, when we're looking at existing assets or opportunities in the development side, you know, we always pull the aerial out and we try to find the closest Starbucks and the closest Whole Foods because we know that's going to drive, you know, investor interest. So when you, besides the location and access to transit, you know, retail is right there, access to retail, grocery typically being the biggest driver from the housing perspective. You know, from the development side, when you start talking about mixed-use development, Multifamily is highly focused in that vertical, and they'll take on some mixed use in terms of smaller retail programs on the grade level or first floor. When you start getting into bigger, larger blocks of retail, multifamily seems to be partnering up with experts in the retail space, like they did at Assembly Square, where it's not their expertise, they're going to stay to the housing above and leave the retail to the experts below.
What's the appetite on the investor side, Doug, when it comes to retail?
If you have a grocery anchored retail, that's a huge plus. Anything convenience driven, if it's unanchored or you have a bunch of junior boxes, that's a lot tougher. But frankly, when you look at Boston and how hard it is to get retail done around here, anything that's, call it inside of 495, people are going to take a look, regardless of what the tenant mix is, as long as they're nationals and things like that in there.
So Doug, let's stick with you and talk about a conversation we've been having in the office a lot about the tax changes. And what impact are you seeing that have on buyer or seller behavior? Is it making a difference yet? Is it too early?
Well, most people seem to think at this point that because they didn't touch the 1031 rule, which was the biggest concern, about carried interest. And the issue is when they took that off the table, most people seem to think that the current tax code changes were fairly neutral for commercial real estate. We'll see as it rolls through a lot of other things, because there's a lot of other items that might take a while to roll in. But for the biggest concern was the 1031 rule, which really wasn't impacted at all. That would have probably crushed commercial real estate in a lot of ways. You think about all the different people that roll over their gains, and whether they be from apartments to something that's more hands-off at a CVS or whatever. Some of the brokerage houses that focus on that triple net stuff would have probably been put out of business.
So let's turn it over to the audience for a quick second. How many of you will be impacted one way or another, think it will actually change your behavior, the new tax laws, positively or negatively? Are a few of you? All right. Thank you. Let's talk a little bit about capital flows. Chris, what are you seeing on the capital flows standpoint from a development perspective?
Well, I think capital flows, as long as the capital markets keep flowing, development will continue. But I think I would be more focused on the other drivers of development, which a very big one is construction costs. A lot of people have highlighted about it tonight, but it is true. I mean, on a monthly basis, you're looking at 5/10, 6/10 of a percentage point motion, and that's a really big game changer. But we really say that no one can predict what the future will be like, but we'd like to think that at some point it will level off a little. It will increase, but I don't think for 10 years it could be 6 or 7% a year. That might be a little extreme, but that also means in this market that we're playing in, construction firms can also be very selective about what projects they choose to be a part of. They want to choose the ones that have the highest likelihood of getting in the ground and going. They've got a lot of power right now.
Doug, what do you think?
I think we're going to have similar volume as we did in last year. The biggest concern, of course, and I'd probably say the caveat, is the inventory out there to sell. There's a lot of folks that have the mindset of, what do I do with the money? Recent months that you haven't seen a lot of new product coming out, not a lot of other opportunities. Investors still remain pretty disciplined what they're looking for, so they're not going to just buy something because there isn't a lot to buy. My concern long-term would be if it continued on that type of a path, would people start to become undisciplined, then that causing a bubble. But, it's still a ways to go before we get there.
Chris, what's changing for you on the capital flow side?
I feel like we've said this the last couple of years. We're just so lucky to be in Boston, and it's we're top 3 nationally, and anywhere from top 4, top 5 internationally. In that, there's a lot of capital trying to look for opportunities. Some groups have been forced to go out to other markets where they can actually find just the lack of inventory and lack of supply that's there. One thing that we're seeing as of recent on the development side is that some of the equity that's out there has actually gotten more aggressive for development sites, just because having to wait to go through a permitting process or just the ability to be able to control a deal. We've seen that capital get even more aggressive. And in the last 6 to 9 months, we've seen a significant inflow where it was quiet for a while in the overseas markets, particularly China. That has now come back considerably strong here in the last 6 months.
Tom, are we seeing changes when it comes to where the capital is coming from, whether it's agencies or life insurance companies or?
Well, I actually kind of wanted to jump on something that Doug said, which was the lack of product available for sale. And there's one of the reasons that I think on the permanent financing side in particular, there's great opportunity for borrowers this year is that there's an oversupply of capital available relative to what's available to be financed on a permanent basis. There's a reason that I hope the investment sales market's very robust this year. But if you think about it, commercial mortgage-backed securities last year ran at about $95 billion. We made it through the wall of maturities that everybody had been concerned about from 06, 07. There's about $80 billion of CMBS that matured last year. Think about this for a minute. Next year, there's $24 billion of maturing CMBS because we were in a crisis 10 years ago. So there's less refinance opportunity. We need to see some of the construction loans get converted into permanent. Assets that are repositioned get converted into permanent. But think that we're going to have CMBS, particularly after risk retention was implemented. They've actually tightened their pricing quite a bit, and they're going to be competing with the life insurance companies that have allocations that have increased year over year. In February, when we go to the MBA, we'll be hearing about the new loan programs and also the insurance companies' allocations for the year. So I'm expecting that in February, we'll have a great sense of a very large supply of capital looking to be deployed.
All right. So with the last minute or so that we have, let's just go down the line. What concerns you in 2018?
Well, I think overall nothing concerns me too much, but I think in general, capital markets might be a dog chasing the tail situation where maybe there's a drive for a certain product type that's going to be built as a value add or being financed, but maybe ignoring other things that are quite necessary contextually in the city.
In terms of what concerns me, I think that I'm not concerned about like structural deficiencies of underwriting like we had last time, some of the factors at play there. What I worry about more from a earnings perspective personally would be some kind of shock in how we respond to it, that shock being people worry about geopolitical factors and they worry about interest rates. Gradual increase in interest rate I think works okay, but if we had a 50 or 75 basis point snap, if we took the whole year's projection and something triggered it, that would be problematic. That might slow the market temporarily. Ultimately, it might be healthy to extend the overall cycle.
Okay. Doug?
I'd probably say, and this isn't really backed up by much other than we're 9 years into a cycle.
Yep.
My other most important thing that I fear is not enough listings for our team, so remember that out there.
Thank you.
Same, listings is always a good thing. But I think we sat here last year, we were talking a lot about inventory and supply that was coming online, particularly in the Seaport, and it's amazing to see what a year has done, particularly in that market with what GE's done and the migration back into the urban market. I think I would agree with kind of Doug's point that where we are in the cycle, and we've said it again, are we in extra innings or where we are? I think that's the biggest thing that kind of where we're watching in terms of what the macro market's looking at.
All right.
But we don't see the speculation, the crazy. I mean, you can talk about how hot the market is and prices going up and such, but again, we still see buyers being pretty disciplined, just not going outside of what they think they want. And when we start to see crazy stuff like that happen, then you probably know you can ring the bell.
Okay. All right. Well, thank you very much. Appreciate you guys joining us up here. And with that, we'll turn it back over to Tom Hines.